The broadcast is now starting. All attendees are in listen-only mode.
Good. Tuesday, either morning, afternoon, evening, whenever you're listening to this. My name is Nick Katko, and I am Senior Consultant with BMA. And this is the fifth and final session of our Introduction to Lean Accounting webinar series. First, before we get started, I would just like to confirm, can everyone see me? Can everyone see the presentation? And can everyone hear me? Please, yes. Okay, so I got a couple responses. That's good. So let us get started. Thank you. So today, we're actually going to talk about one of my favorite topics, which is dealing with standard costing. And the second topic we're going to talk about is how do you actually implement lean accounting. So we have like two distinct topics that we'll deal with today. So our agenda is we're going to start with dealing with standard costing. We're going to talk about what do generally accepted accounting principles say about standard costing and what don't they say about standard costing. We're going to talk about how do we value inventory in a lean company and maintain GAAP compliance using simpler methods. And then I'm going to show you some examples of how lean companies can value inventory without using standard costing. Then the next topic is we'll talk about how do you create and manage a lean accounting transformation plan. Finally, we'll wrap up with questions that you may have. So let's get started. Lots of material to cover today. So dealing with standard costing. This is the topic of standard costing, which really applies primarily to manufacturing companies, is really where lean accounting, and financial accounting converge. And the area of convergence is the valuation of inventory. And I have been fortunate as a CFO when I first learned lean is that I did turn standard costing off in the company that I worked for and went to a lean inventory valuation methodology. I've also worked with companies as a consultant, and I help them through that process, both public and private companies. And I have also worked with some companies where their inability to deal with standard costing in a lean transformation has really stalled the lean accounting transformation. So if you are an executive in a lean company, if you are a finance or an accounting professional in a lean company, if you are a lean operational or lean management person in a lean company, if you use standard costing, this is a topic that you as an organization, you're going to have to deal with it. It's as simple as that. You don't have to deal with it on day one, but you have to deal with it. And as I go through this presentation, I'll give you some tips and pointers on how to deal with it. As I talk about the standard costing and lean inventory valuation, I will start talking like a financial accountant. So for any of you who are non-accountants, if you get a little confused, I'm sorry, the accounting people will understand what I'm talking about. So the first thing is to understand what do generally accepted accounting principles say about inventory valuation and cost of goods sold. I'm using the term generally accepted accounting principles, but I also mean the International Financial Reporting Standards, which are basically the same as what we in the US commonly refer to as GAAP. So generally accepted accounting principles say that inventory must be valued at actual cost. The actual expenses incurred to get goods in condition for sale. This would be the cost to acquire all the parts and products. It would be some portion of the production costs. And GAAP acknowledges that it involves many considerations. So the inventory valuation GAAP rules were written many, many years ago. And even back then, they understood that inventory valuation is a complex issue. The other part of GAAP is the valuation of cost of goods sold. How do we determine the proper determination of income through the process of matching appropriate costs against revenues? Now, in financial accounting language, we call this the matching principle. It doesn't apply just to inventory in a manufacturing company, it applies to all businesses, matching the matching the costs incurred to generate the revenues that are recognized. So we have these two issues that we have to deal with. How do we value inventory at cost? How do we properly determine income through the process of matching? What GAAP recognizes is that in a manufacturing environment, it is very, very difficult to match specific costs to the revenue recognized. This is due to the continuous nature of manufacturing. Manufacturing is the production of products is always going on, never really stops. And in some companies, it's a 24-hour day, 7-day-a-week operation. So what are the difficulties? One difficulty is that products that are sold are not produced in the same period. So we might have products that are being produced today on January 30 and may not be sold till maybe February 10. Sometimes this time frame is even greater than a few days. It could be weeks, could be months. The other difficulty is that prices of materials change over time, especially if you're dealing in a commodity. And the third difficulty is that production costs change over time. So GAAP has recognized that, trying to take the actual costs in manufacturing and match it to the actual revenues incurred is very, very difficult. So what GAAP has come up with is what they call creating a cost flow assumption. So manufacturing companies are allowed to use a cost flow assumption, and there are certain conditions that have to be met to use the cost flow assumption. One is consistency. That companies must select a consistent method, and they can't change year to year. This method of cost flow assumption must be disclosed in any audit reports of the company, and if you do change cost flow assumptions, it is considered a change in accounting method and must be disclosed in all financial reports. So it's about consistency over time. So what GAAP doesn't want to happen is for companies to switch cost flow assumptions every year based on what's most advantageous from a profit standpoint, because what that would do is the readers of the financial information, for example, stockholders or potential investors, they would get very confused about the fluctuation in profit. So GAAP has recognized 4 cost flow assumptions. And if you have an accounting background, you know all about these assumptions. Number 1 is FIFO, which means first in, first out. And this means that the most recent costs are assigned to the ending inventory, the oldest costs get assigned to cost of goods sold. LIFO, which means last in, first out, is that the most recent costs are assigned to cost of goods sold, the older costs are assigned to inventory. Then there's the average cost method, where inventory and cost of goods sold are the average cost of all the goods available for sale. And finally, the specific identification method, in which the specific cost of each product can be accumulated. Specific identification is very, very rarely used in companies, but I'm sure that there's some manufacturing companies out there that can use it. So we have these 4 cost flow assumptions that if you use them, you are complying with GAAP. Now, if you change, you have to disclose. So that's what GAAP says. And one thing to notice, nowhere in our discussion thus far has GAAP talked about standard costing. So let's talk about how a lean company complies with GAAP in terms of inventory valuation using simpler methods. And what I'd like to say here is that GAAP does not codify standard costing. Standard costing is just a system to value inventory, but it is not explicitly stated in GAAP that you must use standard costing. So that's a very important point to understand. So let's talk about lean inventory valuation. Lean transformation is designed to reduce inventory levels in manufacturing companies. That is a typical outcome of a successful lean transformation. I often like to say if a company says they're lean, but inventories are not really moving, they're not applying lean practices in the right way, inventory levels will come down because inventory is considered waste. A target of 30 to 60 days of inventory is a good range where a company can employ simpler inventory valuation methods than standard costing. You might even be able to get to 90 or so, but typically 30 to 60 is the target. When inventories are reduced into the $30 or $60 range, the financial risk of inaccurate inventory evaluation goes down significantly. So there's less risk involved in materially misstating profits. So that's another important consideration, and it makes it easier to simplify inventory valuation. The third part is methods, is that there are simpler methods that other than standard costing that can be used in valuation of inventory and maintaining GAAP compliance. We're going to go over a lot of these examples. So even though today you may be beginning the lean journey, you may have a lot of inventory, and you may be using standard costing, this is really an opportunity. This is a destination that you can achieve over time. Again, you don't have to deal with this on day one of your lean transformation. But as a CFO or as a controller in a lean organization, it's very important to understand that this is an opportunity and that at some point in time in the future, you will have to face this issue. So I always recommend from a company viewpoint that you begin having high-level discussions about standard costing at the beginning of your lean journey to talk about where we can go with this and what can happen and when. And I'll give you some examples as we go on. lean companies comply with GAAP by using the average cost method of the cost flow assumption. That they don't use LIFO, they don't use FIFO, they use average cost. Now, it's the average cost of all the goods available for sale. It is not on an individual product by product basis. That is the key, is that what we're doing is we're trying to get away from the valuation of every single product. That creates the complexity and all the confusion in a standard costing system. What we're trying, where we're trying to move is we're going to value all of inventory on an average cost basis. And again, it's very important that you have to have a relatively low level of inventories to be able to move to this. Yes, it is a change in accounting method, but it works. And it is fully compliant with GAAP. Auditors will accept different valuation methods if you work with them to establish it. So let's talk a little bit about the different components of inventory. First, let's talk about material. Now, the valuation of material is quite simple. It's the quantity multiplied by the price, and you get total material cost by each part or in total. So from a quantity standpoint, when you're in a lean environment, if you have few parts, you can probably do a monthly physical inventory because you don't have much material on hand to get your quantities. If you have many parts, which I think it's safe to assume that most manufacturing companies fall in this category, it is better to maintain your quantities on hand in your ERP system. Because if you tried to get rid of material quantity in an ERP, you have to find some other methodology to track quantities, which might be Excel spreadsheets, but that would be very, very cumbersome and complex. So keep your ERP system with quantities. So that's how we deal with the quantity piece. If we look at the cost piece, if you have few parts, you want to use an average cost per unit or an average cost per day to get your unit cost. Then you have your quantity times your unit cost, you can multiply together. If you're tracking individual material quantities in an ERP system, you have to value each individual part. You can use average cost or maybe last price paid. Now, a lot of people in lean accounting are not fans of ERP systems, but I think the reality is ERP systems are necessary in manufacturing environments. The question is, how do you use the ERP system? So my recommendation in general for material is keep it in ERP, but don't use a standard cost. Use an average cost or maybe the last price paid. Now, for the capitalization of production costs, and this is really where the benefits of lean inventory valuation come in, and it eliminates a tremendous amount of work when you don't have to calculate labor and overhead and value each individual part in terms of labor and overhead. From a lean viewpoint, our actual production costs are from the value stream income statement, which we talked about in session 3. The capitalization of these production costs is done at a macro level using a journal entry. So we're not going to calculate labor and overhead, as we say in standard costing terminology, for every individual part. We're just going to say, here's our finished goods material value, and here is a lump sum of production costs that are capitalized based on the material cost value. This can be done using a journal entry, and it is very simple and easy to do. The final aspect of this is that when you get to this point, you can set your labor and overhead rates to 0. If you are audited by an outside CPA firm, then what you want to do is get them involved in creating the methodology. And before I move on, I would like to say that, this is actually something that I did, is to use the journal entry. It can be done. It is a tremendous opportunity when you set labor and overhead rates to 0 in an ERP system. The majority of the traditional type problems and issues with costing go away. When your labor and overhead rates are 0, you don't get variances anymore because the ERP system, when it multiplies some standards by 0, it's 0. And absorption also goes away. So all of those discussions that go on in a company using standard costing regarding variances and absorptions or this cost, product cost, or that product cost, they all go away. It is a tremendous opportunity. When I was able to do this as a CFO, the manufacturing people loved it because the inventory reports were just material cost and they understood it. Those sales and marketing people, they liked it too. They understood this is the material cost of the product. We get a good contribution margin and we can figure out profitability off contribution margin. So let's talk about the different methods of capitalizing production costs. One is a days of inventory method, where you count the inventory, calculate the days, and then you use the ratio of the days to calculate value. You can also use the ratio of units to calculate the value. You can use days of conversion cost, and again, conversion costs are the actual production costs. This works well if you're just going to capitalize labor and overhead and your material cost is still in your ERP system. And finally, historical margins and maintaining that. So what I'm going to do now is show you some examples of how all of these systems work. So here's the days of inventory method. On the left side, you see a value stream income statement with actual revenue and actual costs for the period. On the right side, we see our total material cost of $849,526, our total conversion costs, which are all the other costs totaled up, $876,550. We have 20 working days in the month, so we calculate a cost per day. $42,476 for material. For conversion costs, which is actual production costs, it's $43,828. If we know how many days of raw material, how many days of work in process, and how many days of finished goods we have, we simply take our cost per day, multiply it by the number of days to get our value. So you can see our raw material value, our WIP value, and our finished goods value. I would like to make a note here on the work in process. The work in process is typically valued at an average percentage complete. We're not going to worry about exactly where in the production process it is. Again, with low inventories, this is not a material amount anymore. So if you look at number 5 below, where it says calculate work in process days, you take the number of days multiplied by the material cost per day, and then you take your conversion cost per day, and the number of days are divided by 2, meaning on average your work in process is 50% complete. The units of inventory method is very similar to the days of inventory method, but instead of using days of inventory, we are using units. So in this case, we have the same value stream income statement. We have total manufactured units in the period, 22,861. So we calculate a material cost per day, or per unit, sorry, and a conversion cost per unit. And then based on the number of units on hand, we do the simple multiplication and we get our inventory value. And you can see if you look over on the left side that the new inventory value of $963,163 is $222,872 less than the beginning inventory. So that would require a journal entry where inventory is credited for $222,872 and cost of goods sold is debited. If you're looking at the days of conversion cost method, we know our inventory value for materials is $474,036. That comes from the previous calculation that we did. We have 20 days in the month, and the number of days of material inventory is 11.16. So what we do to get our conversion cost is we take the ratio of the number of days of inventory over the total days. So if you divide 20 into 11.16, take that percentage, which comes to roughly, I think, 56, 57%. And if you multiply that by the total conversion costs of $876,550, you get conversion costs of $489,115 that need to be applied to ending inventory. And again, our value is $963,151. As I mentioned earlier, this method is good if you maintain your material cost in your ERP system and you're really only trying to capitalize production costs. The final method is maintaining historical margins. And in a few times when I've done this with companies, the auditors are very concerned about the consistency in the reported margins over time. Because again, if you're looking at audited financials and margins change very quickly or suddenly year to year, readers of the financial statements are going to wonder why. So this process has 4 steps where to maintain historical margins, what we need to understand in the standard costing system is what percentage of material cost is labor and overhead. Then we set our labor and overhead rates to 0 at any month end when we wanted to make this change in valuation. We revalue inventory in the ERP system so that it just shows up to be material cost. We do a journal entry to capitalize the production costs that were in there under the standard costing system. We open a new accounting period and we manufacture. And then at the next month end, we calculate the change in the capitalized production costs. So I'll show you an example here of how this works. So here we have 4 value streams: the stand value stream, the calibration value stream, the measurement value stream, and the optical tooling value stream, and the total inventory of all 4 value streams. So this is under standard costing. And what you see is that the labor and overhead percentage as a ratio to the material cost is 44% in the stand, 18% in the calibration, 89% in measurement, and optical tooling 74%. because these value streams are quite different in the products they produce, this is why we have differences in the labor and overhead as a percentage of material cost. So what we're going to do is we're going to use these percentages maybe for the next year to help calculate the actual production costs. And I'll show you that on the next slide. The first thing we have to do is we have to turn our labor and overhead rates to zero. So if you look at the T accounts below, number one is we revalue inventory in the ERP system. So we set our labor and overhead rates to zero and we revalue. So what happens in the general ledger is that material is credited for the total labor and overhead, and it goes back to cost of goods sold. Now remember, our system, this is like at year end or maybe at a month end, so we have no production going on. We're just freezing production, and we have to work the system before we turn production back on and any kind of reporting. So our system shows inventory now just at material cost. So number two is we have to do a journal entry to bring back the capitalized costs. So we credit inventory, or we credit cost of goods sold for the 556,754, and we debit a new account in inventory called capitalized production costs. So now our balance sheet is correct as of, for example, December 31st. But we're not using standard costing anymore, but it's still correct. The next step would be, for example, the end of January. So we have our ending material for January by value stream, and in total you see it's 997,514. That's the second line from the top. Using our labor and overhead percentage as material cost, you simply multiply the ending material value by the percentages to get what the capitalized production costs need to be. And that totals 572,529. Currently, we only have 556,754 capitalized production costs on the balance sheet. So we have to debit capitalized production costs 15,775, and we credit cost of goods sold for 15,775, and at the end of January, we now have a proper valuation of inventory, and you would repeat this month by month. So those are the four examples. I realize these are difficult to see on a webinar because there's really no interaction. And so if you have any questions about some of these examples, I'll try to answer them at the end. If I can't answer them at the end, I'll be glad to discuss these with you via email or possibly a follow-up phone call. So let's wrap up dealing with standard costing. So here's some practical advice. This is a journey from using standard costing to value inventory to lean inventory valuation. So at the beginning stages of your lean journey, continue to use your current method of inventory valuation. What you want to look at is how can we reduce and simplify transactional reporting and the complexity of setting rates. What I like to say is try to reduce your labor and overhead rates. Try to reduce reporting transactions. Stop reporting actual labor to work orders, things like that. There's lots of opportunity, and what that opportunity does is you're actually eliminating unnecessary work. You're creating time both in the manufacturing operations and also in the accounting function. So as your journey continues, stick with your current method, but try to keep simplifying. In my experience as a CFO, we actually dramatically reduced our labor and overhead rates even before we became a lean company. We had, I don't even remember, many rates, a lot of complexity, and it really distorted things. So what we did is we just simplified. And the interesting thing is that if you reduce the number of rates in standard costing, everybody thinks it's really going to change a product cost, but it doesn't really change it that much. And finally, when you get to 30 to 60 days of inventory, this is where you can use your value stream income statement to get your actual costs. You can turn off your labor and overhead rates and work towards creating a lean valuation system. The method that you select for lean inventory valuation needs to be specific to your company, the exact mechanics of how it works. I gave you some examples. Those are just sort of starting points. But you have to work with your company. You have to understand your inventory situation, the number of products that you have, and any kind of auditing reporting requirements to come up with a system. The goal is to have a simple system but maintain GAAP compliance. The key to simplifying inventory valuation is the capitalization of production costs, a macro valuation method rather than a micro valuation method. This is really the key. This unlocks a lot of time by the elimination of maintaining standards, analyzing standards, reporting on the shop floor, etc., etc. Practical advice, as I said a few times, is keep your material in your ERP system, quantities, and use actual cost. That's the simplest, easiest thing to do. And finally, get auditors to buy in on this. I worked with our auditors for a few months. I told them what I wanted to do before the year end. I wanted to go to a simple system and turn off labor and overhead rates. And so we created a few different methodologies. We experimented with them at month end in terms of what does the valuation give using a spreadsheet and a journal entry versus the system. And we came up with a system that the auditors could test. And once they were comfortable that they could test and validate the accuracy of the valuation, they were all for turning off standards. So that wraps up talking about standard costing, and now what I'd like to do is move into how do you actually transform into a lean accounting system. We've worked with many companies over the years. As I said, I've done it as a CFO. And here's some sort of high-level practical advice. First, we have to think like lean accounting. So especially the financial people in a company and also senior executives. One, understand lean from a financial viewpoint. We talked about the economics of lean. How does a lean transformation impact a company's financial performance? And this is pretty standard across companies about eliminating waste, creating capacity, and growing revenue. It's not radical, it's not earth-shaking. When you hear about lean companies that have had tremendous financial success, it's all about what we talked about with the economics of lean. Accounting professionals in a lean company need to recalibrate their focus not just on external financial reporting. That's important, and you have to maintain GAAP compliance in all aspects of financial reporting, but you also have to recalibrate your brains and the way you think to serve your internal customers. That's really the point of lean accounting. And the primary customer is operations. Management accounting systems in a lean company must change. You cannot hold on, especially if it's in manufacturing and based on standard costing, but it has to adapt. And what you're doing here with lean accounting is you are creating a new management accounting system which has to replace the old over time. So it's not you don't want both systems. You don't want the old system and the new system because you'll get too much conflicting information. So this is a transformation of management accounting. The accounting function must lead this transformation. And finally, the creation of a lean management accounting system in no way compromises financial reporting and GAAP compliance. One of the most important aspects of a successful lean accounting transformation is senior leadership team support. I have seen it work when the senior leadership supports lean accounting, and I have seen it stall and fail when senior leadership does not support lean accounting from beginning to end. So lean accounting needs to be part of your lean strategy. It needs to be explicitly stated to the company and known to everyone that we will create a lean accounting system. You need to assign people to the lean accounting transformation. Now, that doesn't mean, when I say assign people full-time, that doesn't mean you take them out of their current jobs, but it's a responsibility. You need a leadership team of finance and operations people that are going to put the lean accounting transformation plan in place. And I stress that it has to be a cross-functional team. And finally, whatever the plan is, senior leadership must approve it, sanction it, and support it. Typically, inside a company, there might be some pockets of resistance to moving away from your current management accounting system. And again, if this is the plan, we have to work through some of those issues, but we'll get there. And that's what everybody needs to understand. I would like to point out that there's been a few times I've worked with companies and they get down the road maybe 3 months, 6 months, maybe a little bit longer, and lean accounting seems to be working. And then all of a sudden another priority comes up. And then all of a sudden, well, we're putting lean accounting on hold. Well, putting lean accounting on hold is like putting lean on hold. You really can't do it. Once you start the process, you have to maintain it, because lean and lean accounting it's not a destination, meaning you don't get there and then you stop. It becomes an everyday thing, and it's always going to be there. So again, I stress, we don't want to not make lean accounting important. The best way to get started with lean accounting is to establish a pilot location. So this would be 1 or maybe 2 value streams inside a business, or maybe 1 location. Much like lean, you want to put lean accounting in 1 area and show exactly how it works with real numbers and real people that work in the company using it. Because what you're trying to do is establish credibility that this is a really good system. And the best people to tell you that lean accounting is working are the customers, the internal customers. So establish a pilot location. Implement lean accounting rapidly. As I mentioned earlier when we talked about our services, we recommend that you use a cross-functional team and a Kaizen approach, where you get a lean accounting system in place maybe in a few months by doing multiple 3-day events. You're using the pilot location as a laboratory to learn about it and to develop standard work. You'll always find areas that you can improve on based on, for example, what we've talked about. For example, your company might be able to do performance measurements a little better, a little differently. Your value stream income statement might have to be adjusted a bit. And you learn this by calculating true real box scores and using them. And I've not worked with one company that, for example, the pilot has gone in perfectly and then there's never been any changes. So this is a process. So after you establish the pilot and you learn a lot, you want to create a formal deployment plan. So this is how do we roll lean accounting out to the rest of the organization? So you have to train people and develop a formal training plan. You want to be very date specific, meaning you want lean accounting in at another value stream or another location at a certain date. Don't leave it open-ended. And you continue to deploy using the same Kaizen approach. The people that were involved in the pilot are typically good enough to train others in lean accounting at this time and help them deploy. And you create a long-term plan based on your lean maturity. Lean accounting can work as fast, lean accounting can be deployed as fast as a lean transformation occurs. I like to say that it's difficult for lean accounting to get ahead of lean, but you want lean accounting to keep up with lean. And part of the long-term plan, as I said earlier, is if you have standard costing, how are we going to deal with it? So let's wrap up and then we'll get to some questions. If we go back to the beginning, session 1, lean is a financial growth strategy. It's about eliminating waste, creating capacity, using that capacity to sell more products and services, managing flow to manage our costs, and creating value and revenue growth over time. That is the strategic foundation of lean. Lean works economically by increasing the growth rate of revenue because you deliver value better than you as a company did in the past, and you're delivering it better than your competition. This leads to tremendous revenue growth. On the supply side, this concept of continuously improving, what that does is it focuses on improving the productivity of the resources who are delivering the value and creating the value. What that does is that manages your cost growth. And over time, your rate of cost growth goes down. Typically where you get is you have, for example, revenue growth now is like 15 or 20% a year. Your cost growth might be in the 5 to 7% range. So if you're in that position in your growth rate of revenue greater than your growth rate of cost, you will be making more money over time. We want to get away from traditional management accounting. In traditional management accounting, profitability is highly influenced by how you do inventory valuation. Why? Because when you have a lot of inventory, fluctuations in inventory are going to fluctuate the profitability a lot. So that creates this need for standard costing. Inventory accounting in a standard costing environment is highly subjective because there are many subjective factors which go into setting rates, setting standards, allocating costs. It's all very subjective, and it influences the profits. And you have this traditional manufacturing viewpoint of achieving our production plan, maximizing utilization, maximizing efficiency, maximizing absorption. That's typically the current state where you start. What's important to understand is the future state of a lean management accounting system. is that reported profits are highly influenced by the flow of work through a value stream. Inventory accounting is immaterial because you don't have as much inventory. And because you don't have as much inventory, you don't have to really have a complex inventory accounting system. What you have to understand is lean operations focuses on delivering value, improving flow, and improving productivity. So the alignment of the management accounting system to lean operations is essential to the overall financial success of a lean company. And finally, the framework for a lean management accounting system is about measuring the business using performance measurements and box scores, accepting the financial principle of lean that maximize flow to maximize profits, creating a lean accounting decision-making framework where we establish the true cause and effect financial relationships between operations and the financial results using a value stream box score. And finally, from an accounting viewpoint, we wanted to deliver value to our internal customers. We want to be able to measure the impact of the financial impact of improvement and create this standard work for making business decisions. We've talked about BMA services. I'm not going to talk about those any. I want to get to some questions. And so I'm going to go here and open up the question panel and answer as many as I can. So the first question is, how does average cost work if you have items with a wide range of costs from a few $100s to five-figure items? So that's a good question, and that's from Susan Snowden. It depends on your values. Remember, we value inventory by value stream, not in total. So I would make a guess is that, the products in certain value streams probably are in a similar cost range because they're similar products. So I guess we're not doing it we're doing it value stream by value stream. And I don't think you have to deal with that as much. I could be wrong because I haven't been in your business, but that's typically what I've seen. So I had a good question from Josh Summers. Don't we want to identify each journal entry as waste? Yeah, I guess you can say journal entries are waste, but making one journal entry to evaluate inventory compared to maintaining a standard cost system, I think is less waste. So let's see, I'm looking at the next question, and this is from Charlene Budd, where she says she sees how using actual labor costs can be tracked to each value stream, but her question is regarding overhead. Is an estimated rate or 1/12 of the estimated total overhead applied to each value stream? And then she goes on to ask, if so, is underapplied or overapplied overhead close to cost of goods sold for each value stream? Well, in lean accounting with the value stream income statement, we have our actual production costs. And we create a method to apply to inventory, and we make an adjustment each month. We just capitalize the costs. We're not looking at applying overhead based on rates. So that's about the best I can answer. I'm not sure exactly what you mean, but maybe we could talk about this outside of the webinar. Kent Bradley had a very good question about addressing the positive aspects of the decline in the asset value of inventory. And when inventories go down on your balance sheet, you create a tremendous amount of cash. That's what happens. And that's another part of a lean transformation that's hard for people to understand because they want to see the profitability impact. But lean, when inventory goes down, it turns into cash. And you get into the position of having a lot of cash to do the kind of things you want to do. When I was a CFO and our inventory went from about 3.5 days or 3.5 turns up to about 25 turns, we actually had so much cash, we didn't know what to do with it. We never borrowed on our line of credit. We were able to pay off all our debt, and we were able to invest in the assets we wanted to invest in terms of capital expansion. Another question here, is there any development or research on the lean accounting side about using big data analytics to make even better use of lean accounting? Short answer to that is no. From a lean viewpoint, the numbers that you use and the data, we try to make that visual and simple and easy for people to understand. It's about creating ownership and accountability. When people have to report a performance measure, they own it. When they can calculate it in a very simple way, they own it. So at one level, the information in a lean company is sort of the opposite of big data. And no, we've not done any research, but I just wanted to point that out. That sort of wraps up the questions. Again, I thank all of you for attending these webinars. I've enjoyed it a lot. Our plan is we're going to offer more webinars probably sometime in March. You may have gotten a survey that we sent out about different topics, and we're going to look at the results of that survey and probably do two or three webinars sometime in March, probably the early part of March. And if you're on our mailing list, you'll be getting information about how to register and sign up for those. And then we plan to continue these free webinars throughout the year on different lean accounting topics. Please feel free to suggest any other topics that you may have. Thank you very much for attending. Enjoy the rest of your workday and enjoy these webinars. Bye-bye.